Hello and welcome to ESG Talk, your go-to source for insights and advice for leaders in environment, social, and governance. I'm your host, Mandi McReynolds. I'm delighted for you to have the opportunity to hear from our guest speaker today, Alex Edmans, one of the world's foremost experts on sustainable investment. Now, here's why I like Alex and why I think viewers like you from 90 countries around the world with over 60,000 listeners would be interested. He's the author of Grow the Pie, How Great Companies Deliver Both Purpose and Profit. He's also the co-author of a textbook, and this is important, Principles of Corporate Finance. He is a widely sought after speaker with the World Economic Forum in Davos and also has one of the most popular TED Talks on this topic with nearly 2 million viewers on YouTube. 2 million viewers. Let that sink in for you. And we get to bring him to you today. This is why I love this guest. He recently had a post and an essay that was called The End of ESG. And as our team read it, we were really intrigued by his perspective as looking at it from the economic lens, as well as how do you lead with not your gut, but really understanding the power of ESG through that lens of economics. So Alex, welcome to the show.
Thanks so much, Mandi. It's really great to be here.
So let's dig in a little bit first to your TED Talk that with this title of growing the pie growing mindset. Tell us a little bit about what's the pie growing mindset to level set for our audience today.
Sure, let me start by explaining, well, what is the pie? So why am I giving a talk about pies when I'm a professor of finance? So the pie is the value that a company creates. And we can think about that pie as being split between investors in the form of profits and society in the form of fair taxes, fair wages, fair prices. And there's many executives who have the pie splitting mindset. So they see the pie as fixed, and therefore the best way to increase your profits is to take pie from other people. So cut wages, raise prices, and pay fewer taxes. And that's why you have people who don't like ESG. They claim it's woke, because the only way that you can increase the pie to others is if you sacrifice profits. And they're saying, well, profits are important because you need them for a return for investors. But why is the talk called the pie growing mindset is, as the name suggests, the pie can be grown. So when a company invests in its workers, not only through higher wages, but through training and development, they're not just giving pie to the workers, they're not just being charitable, they're growing the pie because the workers are becoming more productive, more motivated, more likely to stay, and therefore shareholders are better off. So this is how I, as an ex-investment banker and as a professor of finance, can be so positive about sustainability, is it's not just woke, it's not just good for wider society, but it's also good for business. You are investing in your stakeholders, and when you create value for your stakeholders, this grows the pie and ultimately delivers value to your shareholders.
Now, I'm a person of practice and I'm very practical. And what I enjoyed about your book and would share with those listening in is you have a whole section in each chapter that's called the nutshell. So you can actually go through your book and read some of the deep theories of economics, or you can dive into just the nutshell section and kind of get some of the cliff notes as you move through the different chapters. Really great for if you are in transportation, whether you're ride sharing with somebody on a train or doing a commute via plane to your next conference. So I would tell you this book is great for that level. What intrigued me was in the book, you talk about Fortune's Great Places to Work list, and it tends to outperform their peers by 2 to 2.7%. Workiva is in its 5th year being recognized as the consecutive leader for this Great Place to Work list. I would love to understand from you as an investment and this idea of investment being in your employees, how investment bankers and others should think about this. Because today on the market, there isn't an ETF formed around the great places to work. But there are other social funds, and I'll dig into that question with you a little bit more. But how should we be thinking about that differently?
I think bankers or analysts, they should think about a human capital as any other form of capital, a really important driver of long-term performance. So you might think, well, why did I even write the study to begin with? So I started it about 15 years ago. So this was way before ESG became so popular. I was doing my PhD at MIT. And what you care about is you want to look at what drives value. But as an investor, you can only make money if what you're using to form your investment strategy not only drives value, but is also ignored by the rest of the market. So it would make no sense to say, oh, let's buy shares in Facebook because they are a leader in social media. People know that they are, and that's why Meta has got such a high stock price. But something like corporate culture or human capital, because some people think, well, the value of a company is in its machines and its tangible assets, they might ignore intangible factors like human capital. And indeed, as I mentioned, my prior job was at Morgan Stanley. And what was interesting was that at Morgan Stanley, you have such strong extrinsic motivators that really you might think culture shouldn't matter, right? Because they were paying you a lot. And if you did well, you got a high bonus and you also got promoted. Wasn't that enough to get the best out of your workers? And it wasn't. Right, how you were treated, whether the boss recognized you, whether you were taken to a meeting, whether your ideas were valued, all of those cultural factors mattered, even in an organization like Morgan Stanley, where you thought the external drivers were so powerful. So that's why I wrote that study about 15 years ago on the link between employee satisfaction and long-term firm performance. And I now believe this is actually cottoning on. So there are some funds which, surprising, and some of them are recent, which is why not everybody knows about them, which are trying to look at the human capital factor. So the longest standing fund is the Parnassus Endeavour Fund. It used to be called the Parnassus Workplace Fund, which sort of gives you a little bit of a clue as to what they look for. They change it from workplace to Endeavour because they also have a fossil fuel screen as well. The ticker is PARWX. They look at companies with strong workplaces. And interestingly, at the time that I wrote my book, they were the best performing fund over the past 1, 5, and 10 years. And notice, out of all funds, not just out of sustainability funds, but all funds. So even as a mainstream investor, even if your only goal is to make as much money as possible, you should pay attention to this human capital factor. And there's, I think, a more recent ETF called HAPI, HAPI, which is launched by Irrational Capital, where one of the partners is Dan Ariely, a very famous behavioral economist. His TED Talk views easily dwarf mine, but he looks at sort of the irrational and human factor. And this also, while the fund itself is relatively new, the strategy it's based on has been back tested and is also linked to long-term performance. So bottom line here is that when you treat your workers well, this is not just being fluffy and nice. This is investing in the most important asset that a company has in the 21st century.
So let's go there, because you make this proposition in the book, and Forbes just came out, Forbes Advisor, with what are the top performing best ESG funds of March 2023. And it is interesting because in your book, you challenge this notion of long-term investment. And I loved where you went, where you looked at the performance of what's the 5-year versus the 10-year versus the short-term volatility factor. How do we think about this in the market when there is that fiduciary responsibility and there is short-term volatility that we have to control for, and the ESG funds are a little bit more of a long-term game?
Yeah, this is a big challenge, Mandi, and there is a fiduciary duty to your shareholders. But in many cases, these investors are long-term investors. So what is a large source of capital? These are pension funds, and pension funds care about what the income is in retirement. It might be 20 or 30 years' time. And notice what's interesting is that pension funds, they care not only about the income in retirement, but they also care about the standard of living in retirement. So when I retire in, let's say, 40 years' time, I don't just care about my income, but I might care about whether the planet is 2 degrees warmer. And therefore, it's not, again, woke necessarily to take these social impacts into account. It is just sensible to think about anything that affects the standard of living. This is why we care about inflation. It doesn't affect the nominal return you have, but it does affect what you can do with your money. And similarly, if there's scarcity of water or food because of climate change, or you can't live in certain areas, that is also something that affects your standard of living. Now, are there short-term investors out there? Certainly, but again, what does it mean to be a short-term investor? It means that my holding period is maybe a couple of months. So let's say I need to sell my shares in 3 months' time because I need to send my kid to college or something. Now, when I sell my shares to you, Mandy, when you buy those shares, you will think about, well, what are the long-term prospects of those shares? Because you will know that when you buy those shares from me 3 months from now, well, when then you hold those shares, you're going to get the returns over the next 5 or 10 years or so on. So even if I myself have a short holding period, I still want the company to do things good in the long term, because that will affect what I can sell them for to somebody else. And this is not just in finance textbook theory. You can look at this in practice. Why is it that the Teslas of this world have such high market values, way higher than their current earnings? It is because the market is pricing in long-term factors. Is it fully pricing them in? No. Markets are not perfectly efficient, but the whole idea that markets are completely short-termist, I think that's a bit more of a caricature than the reality.
So let's talk about this idea of long-term versus short-term. When we look at the funds that have performed well in the market, we have seen some really strong longer-term performance around the E. So when we look at green investment funds, some of that is because if you even unpack those funds a little bit more, you see a high investment in tech. Now, you take the other alternative to that, and we look at FT's response and kind of unpacking a little bit of the gender funds or some of these other targeted social thematic funds that have not performed as well on the market. And there's an interest, and people are like, oh, I'm willing to sacrifice for return to invest in my values. And some of that, as you unpack it, is, let's say the fund is focused on gender. They haven't been able to invest in tech because the tech market doesn't necessarily reflect a balanced workforce of male versus female at this time. So is it far better to invest in the future of women in tech or future of diversity in tech than necessarily the funds of the market? And so you kind of get at some of this concept with the end of ESG and some of those pieces, but I want to hear a little bit from you is how do we balance that when the makeup of the social funds can limit those returns because it's also dealing with larger systematic issues?
I think you raise really important issues, Mandy, and these are issues that are often swept under the carpet in discussions of ESG. So you think about ESG as a monolith, right? Those three letters belong together. But one of the points that I make in the end of ESG is actually these are quite separate things, and you could do well on the E, but not on the S and the G. It could be that you're investing in tech, but as you say, you might have male overrepresentation in the tech sector. Similarly, you might say, well, an environmentally friendly energy company is closing down a lot of coal-fired power stations, but that makes people redundant and therefore it hurts the S. So while I do believe generally in the thesis of grow the pie, there are ways of making everybody better off, there are still trade-offs. And I really like your question, because what really makes this a complex issue is the existence of trade-offs. So I think it doesn't really make sense to say that I am an ESG investor. What does that mean? Because when there's trade-offs, then which are you going to go for? Instead, it's to state, well, what are the values and the specific ESG priorities that you're going to have? Now, one thing that you could say is, let me go purely for financial materiality. I am only caring about ESG to the extent to which ESG drives long-term returns. And there's nothing really selfish about that, right? If you're a pension fund, you do care about the returns to your pensioners, and also those companies that do good long term, they're also doing good for wider society. But if that's the case, you want to look very carefully at the academic evidence and look at, well, what are the ESG factors that are linked to returns, which are the ones that are uncorrelated, and only focus on the former. And there are certain factors which unfortunately are not linked to returns, like diversity. I really appreciate you bringing this up, because even though you and I would both want diversity to pay off, given one, we're both minorities in different ways, this is actually not there in the data. And this is not to say that diversity doesn't matter, but diversity, particularly diversity, equity, inclusion, is so much broader and so much richer than a simple measure as to whether there's a female or an ethnic minority on the board of directors. So I think it is that just current data sets are not rich enough to capture the huge sort of plethora of things that go into DE&I. But it can still be that you think that the goal of ESG for you is not just to make as much money as possible, but just to promote females or ethnic minorities in the workplace and entrepreneurship in leadership positions. And the fact that there's no relationship, it means at least there's not a negative relationship, so you can get the diversity element without a cost to future financial performance. But if so, you will say, well, what we're defining ESG in as is, it's for us, it is a diversity-based fund. We're not going to claim that this is always going to be leading to higher financial performance, so that's fine. Right? Why do I, for example, buy organic meat rather than traditionally farmed meat? It's not because it's good for my wallet. I know that there is a sacrifice, but I am willing to pay this sacrifice. And I think why ESG has got a bit of this backlash is that there are some sort of over-exaggerated claims that ESG is going to achieve everything. You can have both positive financial returns and always good social returns as well. And while that is often true, that's the grow the pie idea, it's not always true. And if you're doing things just because it's the right thing to do, well, say you're doing it because it's the right thing to do, not saying that I'm definitely going to get higher financial returns from this if that's not there in the data.
I love where you went on the data and the data that is available. And so what is easily grabbable and comparable, particularly when we look at workforce topics, and one of those topics being diversity, equity, inclusion. I think an earlier show with Tanzi Whalen from NYU Stern was really wonderful because it looks at these complex topics and say, how can you combine the financial outcome with the outcomes that you're measuring as it relates to human capital as a company and how they draw both mutually forward for your business. I think that's going to go a lot further in the market in the next 2 years. The other part that I think about, want to unpack with you when you talked about that data side, and this is where I really want to push companies and practitioners in the field. If you are not looking, if you're only looking at one number that is easy for an investor to grab, let's take DEI, for example, and you're just putting it out. You said, so well, we've got X number of women on a board. Great. What matters more for culture to have an alpha return in the market is how do those diverse populations, individuals like you and myself, actually feel like they belong and are included in adding value to the company's outcomes comparatively to the majority in the population. Because that is a true cultural notion of alpha, and data that can show you that when you take your employee engagement, like the Great Places to Work, and you look at the Trust Index Fund, and you look at the data and you say, okay, but where does this compare? Are they higher? Are they lower? Are they equal? If they're near close to equal, you are building then that culture of inclusion and innovation that ultimately will drive your market forward. It's not just about a number, but it's about the outcome. And we as a society have to go further down that road with work like out of NYU Stern, or taking the Great Places to Work and unpacking it so that we can actually drive an alpha in the market. And investors, I would challenge them, need to go after numbers that aren't as easy to grab.
You're absolutely right. And sort of one of my concerns with the way that ESG is going is they're trying to measure everything. Is to say, as long as we have this universally widely accepted metric, then everything will be correct. And obviously, as a professor of finance, I believe in the power of data, but also we need to acknowledge the limitations of data. You cannot measure everything. So the problem with a simple number, let's say gender diversity or ethnic diversity, is that if we know that everybody's going to look at that, we're going to manage to that measure. Right? We might not care at all about inclusion or equity, or we might not give a job to a white male from a different socioeconomic background because it's not going to tick the box. We know that problem with quarterly earnings. Right? Quarterly earnings are a standardized measure. Everybody focuses on them, and then we were focusing too much on quarterly earnings. About teaching, we know about the problem with standardized test scores. This is something that No Child Left Behind introduced. They said, if we have a common measure, there's accountability and comparability, then teachers talk to the test. And we're not learning the lessons from history. If we try to have this metrics-driven approach to ESG, then number one, it will be that companies will manage to that measure and ignore the other aspects of equity and inclusion and other forms of diversity beyond ethnicity and gender. And number two, if everybody sort of agreed on that one metric, then that would be in the price. And so as an investor, you would not be looking beyond that. Actually, the conversation I just had before this podcast was with a forward-thinking investor, which really looks to the long term as to how to evaluate a company's corporate culture beyond what is publicly available, because they recognize that if it's publicly available, it's likely to have less investment value. So what that requires is you to get into the weeds of the company, to get your hands dirty. Perhaps it might involve going down to the shops if it's a retail company and seeing how workers are treated. So this is what legendary investors like Peter Lynch and Bill Miller used to do. But we want to think about just not leaving our desktop and just doing an arm's length analysis, but that is not appropriate for assessing something as human as a company. A company cannot just be reduced to a spreadsheet of different numbers.
And those are some of my favorite investor conversations. I love when an investor comes to our global headquarters or comes to our Amplify conference with users and are seeing our customer experience. They're experiencing with our team the live demo to see about the opportunities in the market. They get to see our employees with our customers on stage, and they really get to understand how the culture is driving the market forward. I want to end with one really final question that I thought was very interesting in your book. And it's where you talk about the challenge of CEO compensation and this idea of driving individuals as joint shareholders. And the reason that sparked attention for me is because, especially in the tech industry, if you look at Workiva, one of our best practices and benefits is our RSU program, our stock program for employees. And we make a significant investment in that you are part of the ownership of this company. You are part of the growth and you're incentivized by the growth of our company. Tell us more as to how companies should re-examine or reimagine this idea of joint share ownership.
Absolutely. I could talk about this on many different levels. So you mentioned CEO compensation, but you also mentioned employee compensation through the RSU program. So let me start with the first, the pay of a CEO. So this is really controversial. And if you want to get people angry, you just tell them how much the average CEO gets paid in the US. It's not that much better in the UK either. But why are people so upset with the level of pay? Is at the heart of it, they have this fixed pie mentality that what you pay the CEO is at the expense of everybody else. So if the CEO just wasn't so greedy, you could take a little bit of her salary away and give this to everybody else. But when you think about the pie growing, actually, it may well be that CEO pay is high because the CEO has created long-term sustainable value. And if her pay is linked to performance, she should be rewarded for that. But that reward is not at the expense of anybody else. It's a byproduct of just doing a great job. So that's why, for me, when I think about how to design pay, I don't think so much as to how to split the pie differently, but how to give the CEO incentives to grow the pie. And this is why I think long-term stock ownership is so powerful. It makes the CEO a co-owner of the business. They're thinking for the long term. And what you can also do is make the CEO continue to hold shares after her retirement, so she is willing to invest in projects that pay off even after her tenure. Notice that that's a slightly different approach from the current trendy thing to do, which is to link pay to ESG targets. Now, clearly I'm a supporter of ESG, but the whole idea is that if you really care for something, link pay to it. Well, that doesn't work in other spheres, right? You don't pay teachers according to test scores for the reasons that we discussed. And similarly, if you paid a CEO based on diversity, they might focus on that, not equity and inclusion, and not other forms of diversity which might not be in the metrics. But if you're paying them according to the long-term stock price, they have to care about hiring a diverse workforce and making them feel valued and included, because that's going to be affecting the firm performance in the long term. So first, in terms of CEO pay, make the CEO a co-owner of the business, make the CEO think like an owner. So we understand how entrepreneurs, they don't just care about how to hit a bonus, they want to make sure that the company grows and that the company's going to be here in 20, 30, 50 years' time. But that also applies to employees, right? Because employees are also really important workers of the firm. So if the company does well, why is it the CEO gets rewarded and nobody else does? Because the other employees had a large role to play in this also. So the nice thing about share ownership is that that can be given throughout the organization. And this just changes the conversation. It changes the mindset. As an employee, you are a part owner of the business. Now, it might only be a small part, but it is still a part. Now, textbook economics will tell you you should never give shares to a rank and file employee. Why? Because if he or she thought like a rational economic man, they would think, should I work harder? Well, if I work harder, I'm so small in the company, I'm not really going to have an effect on the stock price. So even though I do hold shares, my effect on the stock price is so small, the stock price is affected by the CEO, not by me, I'm not going to bother. But people do not think like a rational economic man or woman. They think, I'm a part owner of the business. I'm valued by this business. They've chosen to give me an ownership stake. I'm going to work without this cost-benefit analysis. And indeed, the evidence I quote in the book is consistent with this, giving widespread ownership in most cases is linked to superior future performance.
I love that you took that topic that is so relevant in today and unpacked it in many different ways for our viewers to think about. So some practical takeaways as our viewers and listeners hear this conversation is go after data that's really going to drive useful decision making. Think about the incentives that can drive the long-term value of your company, from our executives all the way down to employees, and share that pie in a way that adds to that long-term value. And as we think about culture, we think about environment, there's more to come in the field as we think about investors and we think about your companies and ways that you can look at that to continue to drive long-term return. And there is hope when we look at the longer term and we continue to think about the fiduciary responsibility of companies and where ESG goes. It's not the end of ESG, it's the evolution of ESG to think about. So Alex, thank you so much for joining us today. And to our audience, we just want to take a special moment to thank you for sharing of your time, digging deep. This moment was brought to you by Workiva, the world's only unified platform for financial reporting, ESG, audit, and risk. If you enjoyed this episode, please share it with anyone you know, because it will challenge our thinking in the future of the field and ultimately drive great impact for business and society. Rank or review us on Apple Podcasts, subscribe wherever you get your podcasts, Apple, Spotify, or YouTube. We'll talk real soon.